Off the lows, as I said, S&P 500 still down by 4.3%. The president, in the commentary you just heard, quote, "It's all going to work out very well," he said, but did add, and I think this is important to discuss here on the desk, there are going to be transition costs and transition problems, is what the president said. Direct quotes there. I guess my question to all of you is, to what degree are investors going to have to face the reality that the transition costs, what does that mean? Is that the trillions of dollars that has been wiped from the stock market? Are those part of the transition costs that investors are going to have to tolerate? Transition problems, is this part of transition problems to what the administration is trying to do? How do you guys think about that statement? Again, if you put it in, total with what we've already heard over the last many weeks, detox, little disturbance. There's been some other commentary too, but now transition costs and transition problems. So
those continue to be vagaries. Those are not telling us what the tactics around the strategy is. And I think until we, the collective, understand the strategy, I guess we're seeing the tactics, but the actual strategy, I think we're going to stay in this environment, and you're going to still have weak CEO guidance, weak consumer confidence, because we're still unclear, what does that actually mean? And so what does detox mean? What does transition mean? I follow this stuff. I have zero idea.
Does it mean $10 trillion wiped out from the stock market? Is that what that means?
Yeah, and sure. I think maybe, but I think it's more about, I would assume they're talking to Main Street. I assume they're talking to Main Street and CEOs. And I just think, if you think about the port of LA, Houston has a big port, the port of LA. They get like 2/3 of their goods from Asia, a lot from China. So what, is the port of LA going to start laying people off because nothing's coming in from China? That's Main Street. And so I just think this is so complicated. And this is where the markets, I think, are going to stay in this kind of Wednesday, Thursday environment until there's some clarity around the transition.
That's the word, clarity. You just need some answers. That's it. But even if you just get incremental, that will be good enough, I think, given where the sentiment is at.
One piece of good news, though, on the tax, like the extending the tax cut front. So the Democratic opposition is completely enfeebled, almost to the point of parity. But if the Republicans want their help to work on extending the tax cut, some of this tariff madness might be like the first casualty of those negotiations. Like there might be a path where the Fed is coming in as soon as this spring, and then this summer, all of a sudden there's a little bit of a break in the logjam with the trade stuff because they want to extend the tax cuts. Like it doesn't have to go down into worst case scenario. It's too early for us to all agree, yeah, this is as bad as it gets.
I think it depends, though, on what the consumer ultimately ends up doing. But I think that's even going to be muddied up because I think there's probably a lot of buying of large ticket items right now ahead of what people are fearing are going to be higher prices.
Pull forward.
Yeah, a pulling forward of demand. So, but I do think at the end of the day, given our economy is so reliant on consumption, if that starts to slow, then that is when the rubber really hits the road.
Let me bring in Mike Santoli, our senior markets commentator, who's standing by for us, too. As you watch the way the markets have been trading today, are you watching the movement in the 10-year Treasury yield more than anything? Because as it goes up, stocks go down.
Yeah, Scott, I mean, what I really, and it includes that, watching is signs of capital flight, portfolio stress, forced repositioning. That's what you care about. It's not surprising after a 9.5% pop in one day, you're going to spill lower and try to test the range we were in yesterday in the S&P 500. The issue does come when you do have these signs, dollar cracking, yields going up again, of, in the effort to reduce the trade deficit, our financial surplus is going down. And I know that doesn't happen that's not the whole story of one day, but I think that's what spooks people, and that's what gets the VIX above 50 again, which it takes a lot of anxiety to do after you've had a 9.5% pop in the index. So I'm watching all of that. The 10-year is absolutely part of that as well. You don't want to necessarily say we're at some kind of maximum alert level on this stuff. But I do think this is the overhang here. If the stock market was just about reacting to what it's been doing, then yeah, those oversold washout conditions and yesterday's massive 97% up volume day and a huge rally should insulate us from further new lows for this move for a little while. That's the kind of stuff where you say, okay, that gives credence to this 4,800 level or so in the S&P 500. But it doesn't really resolve or give people conviction about betting on immediate upside, I don't think, in a sustainable way.
It's like the only place it looks to hide today, aside obviously from cash, and you're getting a better yield than maybe you thought you would, as gold is back green, but Bitcoin's down. The dollar's just getting hammered. I mean, the euro touched 112.
Yeah. No, exactly. And, the Swiss franc is flying. So, I mean, I think that's what people look at and say, okay, this is something a little bigger than, what are we going to have to revise U.S. GDP down to based on the frictional cost of the tariffs. And obviously the China piece of it is kind of massive. And now you have this environment where I think, as we said yesterday afternoon, what the president did by his turnabout was cut off maybe the extreme negative tail scenario. You just don't know how close to the tip it was cut off and, what potential downside remains and whether the market's going to have to keep testing the administration and vice versa.
We don't know either, let's be honest, what sort of damage was caused within the tumult, and the turmoil within the bond market. Who got on the really wrong side of that? You don't learn that in an hour or 3 or 5 or a couple of days. Sometimes it takes a while to see who had some maximum pain, and then you have to clean up the mess after the fact.
Sure. Although a lot of times, a body floating to the surface it kind of does mark the end of it, or at least we can quantify or have a sense that maybe the damage has been done. And it doesn't always happen that way. Honestly, if it could just be a real tidal turn in people's preferences of what they want to own and what they don't want to own globally, then maybe we're not necessarily going to have to find an absolute victim on all this stuff. Saying all this, within the equity market, you had this massive reset. I'm really eager to see how stocks react to what's going to probably be lousy earnings and outlooks, because that's going to give you much more of a hint of what we've discounted already with what we've done here with a near 20% move in a pretty short period of time.
Good points, and thanks for being with us. And I'll see you in a little bit on Closing Bell. Mike Santoli.